Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, good morning, Ben.
Good morning, Will. How are you?
I'm doing pretty well. The scholastic semester at Ohio State finally wrapped up, so I'm, not scrambling to get stuff done, here and there and everywhere, so that feels a lot better.
We're not quite done yet. Our students have got this week and then finals next week, so they're not off the hook yet for the summer,
Yeah,
but
it,
close. They're getting close. You can feel the optimism growing.
it's been an interesting adjustment, because I did undergrad at Mizzou and now I'm coming out here, and it's the schedules are totally different. It feels like it's just a little bit odd, but
Yep.
oh well, just makes you homesick for little things, right?
Uh-huh.
But no, Ben, looking at this week, we saw a lot of slight drops and a little bit of downness in the market. Can you give us a recap of where we're sitting compared to last week?
Yeah, so now that the calendar is turned to May, we also are moving our contract months here as well. So our nearby contracts are going to be July for most of these commodities. So July corn down 23 cents to 584 on the week. December corn down 21 cents to 525. July soybeans down 9 cents to 1427. November soybeans up 4 cents to 1275. So a little bit of spreading there in those contracts. Soybean oil was basically flat, or excuse me, was down basically a penny per pound on the week. Soybean meal was down $3.80 per short ton. New crop July wheat was down 37 cents to $6.18, and then that West Texas Intermediate crude was down $2.50 per barrel.
So, Ben, what really led us to where we're sitting at today? It's been kind of a quiet last couple of weeks, but what kind of highlights have you seen in the markets?
Yeah, and we had quite a bit of highlights actually last week, so I'll try to make these as concise as possible. I'll just simply say that U.S. gasoline demand surged on the most recent week of reporting. That might be some general optimism in the general economy. U.S. gasoline demand was up 12% week over week. On the ethanol side, we saw ethanol production fall just a little bit, which kind of tighten that stocks again. High demand, a little bit lower production, tighten those stocks. So we see a little rise in ethanol prices. Export sales for the old crop marketing year, so the 2022-23 marketing year, were neutral on the week. Everything was within expectations and pretty much in line with the week before. It should be, pretty, I guess, noticeable, or at least I should mention that it was noticeable that there was no new crop sales. Only wheat saw a little bit. Of course, their marketing year starts here in about 4 weeks, so maybe not surprising that we saw wheat. A little surprising we didn't see anything else. It's Federal Reserve week in the market, so we've seen a lot of the managed money, a lot of the positions within the futures and options kind of consolidate. Open interest fell hard across the board, led down by corn at 7.2%. Soybeans were down 12.4%. Soybean oil was down 5.2%. So again, traders consolidating ahead of the Federal Reserve meeting this week. Weekly grain exports were steady to bullish. For corn, this was actually it exceeded all expectations, and this was a marketing year high for corn export shipments. Soybeans, wheat, and grain sorghum were all within expectations for the week. A soybean crush for crude oil. So we got that beginning of the month crush number for March. So this would be the March report that we just got. Soybean crush for crude oil was up from February. It was up from March of the previous year. It represents the second highest crush month ever, only behind December of 2021. So soybean crush continues to be strong. On the fuel ethanol side, fuel ethanol was down from both was up from February, but down from March of last year. Again, that kind of follows this trend we've seen in lower fuel ethanol production. Crop progress, again, continues. We saw U.S. corn planted up 12% from last week, right around that 5-year average. However, that was a little bit slower than what the trade was expecting or what analysts had thought going into the report. Soybean plantings continue almost at a record pace. So very strong soybean plantings. And then that winter wheat conditions rating, we saw a little bit of an actually increase in the good to excellence ratio for all winter wheat, but I'll note that almost all that gain was in the Pacific Northwest, with many of the plain states continuing to see some deterioration. So a little bit of difference based on geographical region. So, Will, I know that was a lot. I'll let you pick what you want to talk about today. But that, in general, what has led to some of this bearish market sentiment over the last week is increasing supplies from the old crop and potentially a mammoth new crop for 2023.
So, well, Ben, looking forward to today's episode. I really want to talk to some of the areas that the crop could be heading toward. So, news from last week out of the EPA, a E15 waiver for ethanol went into effect, or is going to go into effect for this summer, allowing sales, up through September. Ben, what's your immediate reaction to this whenever you're thinking about what that could mean for first, fuel prices on the road during the summer driving season for consumers? I know sitting here in Ohio, it just feels like gas prices keep creeping up, and right now they're hovering around the 340, 350 mark.
Yeah, so we try to be as objective on the policy side, or we are objective, I guess, on the policy side. So I'll try to give an answer here that kind of avoids the policy and talks directly to the market side of this. So as you mentioned, EPA last week granted a waiver for this summer. Earlier this spring, it was, there was a rule that was brought forth that is going to allow E15 to exist during the summer driving months starting in 2024, but that left this summer pretty much unprotected. And so many agriculture advocacy groups, those that support ethanol and renewable fuels, really worked hard to kind of petition for an emergency waiver this summer. That deadline was May 1st. Basically, you kind of need that to be able to get higher blends ethanol, so retailers can prepare by the time the summer driving month, or that restriction starts June 1st. So May 1st is kind of that cliff, if you will. And we got that last week, or that the EPA announced that they were going to allow E15 to exist during the summer driving month. So it came kind of in the 11th hour, very similar to last year. Some of the justification from EPA's report was higher gas prices, OPEC announcing maybe announcing more production cuts in their oil production later this year. So EPA went forth to kind of signal that this was a way to help lower or provide some benefit to gasoline prices over the summer. So that's kind of the background. That's kind of my subjective. That's what happened. I'll just simply say here that this probably does more for long-term development of E15 than it really does for short-term use of the product. The ruling earlier this spring to say that E15 would be allowed over the summer driving months in the future, I think has a better opportunity to expand corn use in those higher blends than these short-term waivers. And part of the reason why I say that is because those E15 blends make up such a small portion of our total gasoline use. Right now, ethanol used in those mid-level fuel blends, which is E15, only make up 2% of our total corn use for the year. And since we have it available 9 months, and now we're adding 3 months, you're taking that 2% and dividing it a little bit further. So maybe an extra 5 to 6 million bushels of corn use this summer as a result of this rule. Keep in mind, we use 5 billion bushels. So 5 million extra out of a 5 billion bushel thing. So as a result, the markets didn't really react to the news that much, but it could signal retailers to add more pumps and continue to blend now that they have more certainty. So well, how is that for an answer, non-answer, Will?
Well, you walk that line delicately, but I think, you have two almost competing thoughts there. One is, yeah, it's just a drop in the bucket, like you said, only adding so many million bushels of use potentially over the summer. But, the other thought process is, well, it has to go somewhere. So every, bit of created demand is helpful, especially like you said, with, expectations of a larger crop coming online, hopefully, depending on the long summer, how things go weather wise and other factors. But been looking forward at the long-term implications of having this available over the summer. How likely are we going to see more and more retailers bring on new pumps and demand really expand, especially as we see newer vehicles that can handle these higher ethanol blends well?
Sure. And so we try to, and when I say we, my factory colleagues, we try to figure out, some way of estimating all these things in a way that it's not trying to predict policy, but to predict kind of where we're at, right? And we don't predict policy. We take
the thoughts and moods of the market almost.
Yeah. And so when we look at this, we do see declining domestic disappearance of gasoline, right? Of liquid motor fuels. And that's a combination of things that we've already talked about, right? Like better fuel efficient vehicles, getting 40 miles to the gallon instead of 15 miles to the gallon or 20 miles to the gallon, right? Not driving as much, more telework, and working from home, right? And then electric vehicles, right? Like those three components just lower domestic gasoline. So we've got a lower picture. However, the drop in ethanol domestic disappearance isn't as much as the liquid gasoline because of these higher blends. Okay, so that's kind of my caveat here, right? And we show that we estimate that this growth in mid-level fuels at E15 over just the next 2 calendar years, so to 2025, potentially could increase 172%. Now, again, we're starting from a small base, right? So 172, gets us up to, let's just say 6%, 7% of our total fuel use, right? For ethanol, right? But that's also partially making up for some of those E10 blends that we see declining as liquid fuels decline, right? So it's making up that
You're
gap.
dropping one area, gaining another.
Yeah. So a good way to summarize this, I think, is like these higher blends are reducing the loss in ethanol production, right? Like it's still declining, but these higher level blends are helping to make up for that. What potentially could happen, and again, I'm not predicting future policy, but I think with this summer approval moving forward, especially for some, a lot of these Midwest states and these Midwest coalition of states, do we start looking at increasing our national blending rate from E10 to E15, right? It's not unheard of. We just saw Brazil do that earlier this month or just last week, increasing their national ethanol standard as well. So it's a long road, and who knows what happens, but certainly I think that is what was on the line, is trying to think about that long run and that future development more so than our current commodity year, our current marketing year.
Well, just I don't know if you meant to slip in a little joke there, but talking about the long road that this is, and potentially the use or more use for ethanol, but obviously, like you said, there's efficiency in competitors within the electric sector that could compete with it. And I think the challenge too, when you talk about this topic, is it's not just, oh well, what kind of supply and demand picture are we looking for ethanol or looking at for ethanol? It's okay, so you have that, but then you also have to keep in mind the evolution and development and bettering of electric vehicles. You have to talk about the efficiency of the cars, like you mentioned. And you have to look at the export market too. So there's so many different levels to this. So, Ben, as you think about, getting U.S. products elsewhere, maybe for ethanol use, what type of picture do you see moving forward over the next, however months, years down the road?
Yeah, so just over the next 2 years, again, I'm going to stick with that kind of 2-year calendar. So through 2025, we have U.S. ethanol exports increasing 16%. That's to places like Colombia, India, Egypt, Europe, right? Those are Canada, Brazil, right? Those are kind of big markets for growth in international ethanol exports. We probably got a little bit of a setback earlier this year. The Colombian government, who was making pathways to increase more corn-based ethanol, has kind of gone back on their own policy and adopted a higher tax. So they have a higher tariff now on U.S. ethanol imports than what originally existed. So that probably slows down some growth in that market, the Colombian ethanol market, but we see growth in ethanol exports over the next couple of years. So 16% over the next 2 years.
So, Ben, I guess looking elsewhere for the rest of this week, what should farmers and ranchers really be paying attention to?
Yeah, so it's the week's pretty much the culmination, let me put it that way, is tomorrow, when the Federal Reserve comes out and announces not just their short-term rate, right? Like, so the market is pretty much banking that the Federal Reserve is going to increase that short-term lending rate another 25 basis points, right? And I think the Federal Reserve will do that because they can't just get too ahead of the market. What will be more interesting is what the Federal Reserve says after that announcement, right? So that press conference where they talk about long run expectations about whether there'll be another interest rate hike again during the next meeting and how long they plan to hold rates at these levels, right? The market is expecting the Federal Reserve to pause after this month and then decline at the end of the year. The market's been wrong for about 15 months now. They could be right about a pause, but I think they're probably a little bit over optimistic about declines later in this year. So that could be where we see the bearish tone in the market spill over into the commodity sector as well.
All right. Well, anyone listening, farmers, listeners out there, if you'd like to learn more about what we're doing here, Ben and I, at the weekly commodity market update, you can do so at brownfieldagnews.com. Also, check out our sister programming, the weekly livestock market update, at brownfieldagnews.com. Ben, thanks as always. I'm Will Robinson on Brownfield.